Every Monday morning at 7:15 a.m. Pacific Time, in my live streams, I am fully revealing my proprietary safe wheel strategy for free. Using my 28 years experience, I've developed the safe wheel strategy to cancel out the risks associated with the normal wheel strategy. I also designed the system to only need my attention once a week on Mondays and on rare occasions Fridays. And this is what I call a level 5 strategy. Now what you see on the screen is the trader matrix. I developed this to make it easy to distinguish between trading levels. After taking over 50 online stock and options courses, I've found that I'm the only level 5 trader that is not using portfolio margin. Portfolio margin is used for large accounts over $100,000. Now after 28 years, I've only found one edge in trading, and that is selling option premium. Level 5 trade systems are the only way to sell option premium efficiently and safely. For a better explanation of the 5 trading levels, see the link in the description for the video called The 5 Stages of a Trader. Okay, let's get started today. All right, so first of all, let me say that if you have any questions, right now is a good time to post those questions. That way we don't get to the end of the broadcast and then I miss the question because we're at the end. All right, so let's see here. We're going to go over the earnings alert from last week. What happened? And you know about my earnings alert trades where I send out an alert once a week. And we can see the results of this particular, we have this particular account that we use. And last week we did Micron Technologies and we had another winner, over $300. So we've done well. Last 8 trades we've had, or last 8 trades. I'm sorry, last 9 trades we've had 8 wins and 1 loss. So we're doing quite well with that service, and I expect that to continue. I'm expecting to win 3 out of 4 trades there. Okay, let's get into placing a trade with a safe wheel. So let's go into that particular account, the safe wheel account. You can see that last week what we did was we sold the $26 put. We're dealing with Macy's, and we bought a $30 call. Both of those expired worthless. Okay, so now we're just sitting in a position with just a hedge. You can see that hedge is doing pretty good today because Macy's is down. So Macy's is at around 25.30. And so what are we going to do next? We're going to do basically what you would do with a traditional wheel. You know, we sold some premium last week, and that premium we didn't get assigned or anything. So we're kind of with a blank slate, and we're going to go ahead and sell some more premium. So what premium are we going to sell? Well, the stock is trading around 25.30. So let's take a look at the options chain. We're going to sell premium here in the options that expire this Friday, so April 1st. So let's look at that particular chain. Now we know that we're around 25.20, so we want to get at least $25 or 25 cents, I should say, on the put that we sell. So I could go with the 24, that's cutting it close, but I'm going to go with the 24.50, get a little bit of premium in here, maybe $35 or something like that. Let's see what we get. So I'm going to sell one of these. Mid price 36. I'll put 37. See if we can get $37 for the 24.50. There's our working orders. We'll work this order. Okay, this thing's moving against me a little bit. Maybe I'll get 35. Okay, so we got 35. Now, we want to protect, where's our positions here? We want to protect this hedge right here. So on this hedge right here, if the Macy's goes super high, like, I don't know, $35 or something, I've seen it happen. It doesn't happen very often, but we do want to protect this hedge. So we're going to buy a long call, and we're going to buy that call, just a cheap, $5 call, $6 call, like right here, the $28 call. We'll just buy this one here. Try to get it for $5. Maybe we will, maybe we won't. Just going to buy one long call. Yeah, so we got it for $5. So now we have our position on for the week, and we'll just, come in on Monday. Now, one thing I want to say, had someone in the comments kind of remind me that if this call, let's just say that we come in on Friday. So I have an alarm set on my phone for Friday at like 10 minutes until the market closes, because I want to be able to sell this call if it's in the money. So it would need to be, if it's in the money, what call did I just sell? The strike price here, the 28. So let's say that Macy's is trading at $29 on the at the end of this week on Friday afternoon, right before the market closes. I'm going to want to sell that call. I'm going to want to collect that premium. I'm going to want to sell that for, say it's worth $1. I'm going to sell that for $1. I'm going to take that money, because if I don't, what will happen is I'll get assigned the shares automatically. So I'll own Macy's at $28, and I'll have to hold that over the weekend. And so there's some risk there, because what if it goes down to 26 over the weekend? So you want to make sure that you do, you want to sell that call if it's in the money. You want to collect that premium, but you don't want to get assigned. Okay, so I just want to make that clear. There might be questions about that, and that would be good if you guys have any questions about what I just talked about. Okay, how are we doing overall? Well, you can see this particular account with the safe wheel, it's up $560 this year. So $560, I started with $5,000. So it's up about 11%, doing quite well. A little bit higher than what I expect. I mean, that's like a year, that's what I would expect at the end of the year based on the back tests. So that one, we're doing really well with the wheel. Safe wheel, I should say. Now, how are we doing with the earnings edge? 780 divided by, started with $5,000. That one's up 15.5%. That one's doing well. If you're okay with some volatility, which I am in this particular account, I think you'll really like this. It's only $259 a month, but you can see that we just made $300 on our last trade. Okay, so let's get into some questions. This one, could you buy a call in the 4/8 expiration? Which expiration are we in? Let's see here. So another week out for $8. So the put hedge comes. Yeah, that's not a bad idea. That would that might work. Something to consider. You'd have to back test that. Let's see, $28 call for 5. Sold at $24.50. $49. Oh yeah, so he got a better price than I did. Richard did. Yeah, I like the idea. That would need to be back tested, but I'm going to just stay in the same expiration cycle to keep things simple personally. But yeah, you could. That sounds like a pretty good idea there. When you initiate the wheel, you buy 3 puts, and when you try to sell 1 put for DTE, there's not enough premium to get 1%. Do you sell 2 puts? No, when there's not enough premium, Javier, I'll come in and do a second cycle. In other words, a layer. In other words, I'll leave that 100. I'll get assigned, right, and I'll have 100 shares. And let's say I can't sell the covered call, right? Then I'll sell a second put. So if I can't get my 1%, I don't double my amount of puts. I go in and sell another put at a lower strike price. But when I initiate, so you're talking about when I initiate. So the thing is, when I initiate, I make sure that I'm trading a stock that I can collect 1% out of the money. So if I can't collect 1% out of the money when I'm initiating, then I need to choose a different stock because there's not enough premium in that particular stock. I hope that answered your question. Okay, Hayden, when you open 3 long puts, are you buying at 80% of the current stock price? Yes. Of the current stock price, not of any strike prices. What's the KGAR and Sharpie ratio? I haven't done those. I haven't plugged those into the spreadsheets that I use. I use FundSeeder. I haven't plugged in those numbers into FundSeeder, so I'm not sure what the KGAR is or the Sharpie ratio. I just know that when I look back over my back tests, I'm looking at around 10% return on average per year from the beginning of my back tests. So maybe that is the KGAR, but I just take, if I did 15% one year and 5% the other year, I'm just kind of averaging it out and saying, okay, I'll make about 10% on average. That's the way I did it. David, how does the earnings strategy work? Well, today's Monday, so I'll take a look and see if there's any earnings that I can trade at a stock that I can trade that's reporting earnings next week. And sometimes we'll get a trade off on Monday or Tuesday or Wednesday. So one of those 3 days, I will open a trade. And I'll put in a GTC order, and a lot of times that'll get filled. But if it doesn't get filled, I'll get out of the trade on Friday. So everything we're trading are earnings that are actually reporting next week. And we have the GTC orders. Well, actually, I'm sorry, it's a limit order. And I hope that explains a little bit about how the system works. You come into Discord, I let you into the private channel, and I put the trade in. And we also have a separate chat that we talk about, and people talk about, when they place the trade and how much money they made and things like that. David, also, is the current P&L from the safe wheel strategy? Yeah, so this is the P&L here for the earnings edge. And then if I go to this particular account, this P&L here, this 557 is from the safe wheel. Wolf, I was assigned Macy's over the weekend, and I'm down 117 while the 3 put hedges total. So if you were assigned over the weekend, I'm not sure what put you had sold. I sold the $26 put, and I did not get assigned, even though we're down below $26 right now. So maybe you sold a put that was a little higher than 26 and you're down. So basically now you want to write a call against the 100 shares that you have. And you want to continue to collect that near-term premium so it will outweigh any problems, the depreciation of your hedge, and eventually come out ahead. Alex, do you have a long form explanation of the earnings edge? No, and I don't really go into the details of how I do the earnings edge either. A lot of people within the group ask me specifically, how did you filter through and how did you pick the stock and how did you pick the strikes and the options? And I don't give that information out. I just tell you, what to do, when to open, when to close, and I hit 8 out of the last 9 trades, so that looks pretty good. So the answer to your question, Alex, is no, I don't have anything that really gets into the details. Michael, how are you selecting which shares to trade on the wheel? So number one, they have to be close to $30, over 20 and under 40. Number two, they have to have enough premium to, if I can get out of the money 1% of the stock price. So for example, if Macy's is trading at $25, I want to be able to sell the out of the money 24 put for more than 25 cents. And the third thing, I'm trying to remember what it was. Maybe it'll come to me, but if you follow those, highly liquid. So when I mean highly liquid, what I mean by that is the bid-ask spread. So when I look at these bid-ask spreads that are close to the money, look at 35 and 39. Like those are pretty close to each other. 31, 37, 20 and 23. See, if this is like 20 and 40, I'd say, well, that's not very liquid. So that's the third criteria. It's got to be liquid. Javier, thank you. You're welcome. Greg, bought the Safe Whale flowchart last week. Set up my first trade this morning on Mara. Looking forward to Friday. Yeah, Mara, I think that's a pretty high flyer. That'll be interesting to see how that one goes. Probably get a lot of premium for that one. Keep me updated. Guy, you may be surprised to learn that chickens have... Okay, that's a waste of my time. Hayden, thanks, Carl. I really appreciate the time you put into doing this. You're welcome. Wolf, I follow your system, but not synchronize with you. Yeah, that could be, and that's okay. You should be able to do okay without me, without following exactly what I do, but you can also follow exactly what I do, and you can scale up too, because there's not a lot of risk in this trade. If you do it right, of course. There's always risk if you're not executing properly. David, for earnings trade, my guess is you look for high AV stocks and create a risk-defined strategy which gives positive expectancies based on probability of profit. Let me think about it from that point of view. No, I'm not really doing things based on IV. I really do have, it is a risk-defined strategy. And the probabilities are definitely there. I mean, I'm hitting 70% maybe if you were to look at all my trades. And my win-loss is usually about a 1-to-1. So if I might make $300 or I might lose $300, but I'm probably winning 70 to 80% of the trades, if that helps. Okay, next, Iraqi and weekly options. So you're maybe continuing a conversation, which confuses me when I do a live stream, so I'm not sure what you mean. Okay, thanks. Okay, good, you got it. How much do you risk per trade? Okay, I think I just explained that on the Earnings Edge. It's based on a $5,000 account. It's about $300. If it was a $10,000 account, I would risk $600. So what is that? 6%? About 6% is my risk, and that about 6% is my return every time I kind of throw a trade out there on the Earnings Edge. What's my risk on the Safe Wheel? It's hard to say. It's hard to come off the top of my head with that. Maybe it's 3% every time I do a cycle, if that makes sense. Okay, so let's see if there's any more questions. I don't see any more questions. So I always have one thing to say. Oh, wait, one more question here. James, if you have a cycle that is down and added a second one that is not the same strike puts, Would you keep both as you are working to break even? Or would you close down the loser and just keep the one not down? I think you're asking if you do a layer, which means that you probably would own 100 shares at that point in your first layer. And then your second layer, you might sell a put, maybe you get assigned, and then you have 200 shares. And so you're trying to sell uh, covered calls against your first layer, which probably you won't get anything. And then you're trying to sell a covered call against your second layer. And then maybe you can't get any premium for your second layer. At that point, you just take your loss and get out. And your put hedge should cover most of those losses because you're pretty deep down into that put hedge. And I hope that answered your question. Okay, more questions. Richard, how does a long call vary this week versus next week's expiration and price movement? I'm not sure when we talk about long calls, we're just talking about something worth $5, and it's just there to kind of hedge our hedge. So I don't know how it varies. It just depends on what the price of the stock does. If the price goes over, what do we do, 28? So the price of the stock goes over $28. There's not going to be any extrinsic value by the time we sell that call. So it's just going to be however much it's in the money, that's what it's going to be worth. I hope that answered your question. JD, please suggest a brokerage you like for trading options. I'm not a fan of Robinhood. I like Thinkorswim. You can see that I have Thinkorswim up on the screen here. James, 2 sets of put hedges. So you're continuing a conversation. What did you ask last time? You have a cycle down and added a second one. No, okay. So if you have a second cycle, you're not ever adding 2 sets of put hedges. That put hedge that you put on, that's the only put hedge, those 3 uh, long puts, that's the only set of hedges you're ever going to put on within that cycle. You're not going to ever adjust those or add to those. Richard, thanks. Okay, you're welcome. Okay, any more questions? All right. I have one thing to say. If the P&L is not real, what else are they trying to conceal?